Did you know that 92% of professional fund managers failed to outperform the market over the past 20 years? But if it's so difficult to beat the market, why not just own the market? Welcome to my channel. My name is Sean, and today I'll be explaining how index investing is possibly the most simple way to build wealth and show you a couple of ETFs that are the most popular among investors. Let's get started. To understand what an ETF is, we need to start from this question. What is an index? An index is a basket of stocks that are grouped together. It can contain anywhere from tens to even thousands of different stocks. It is designed to measure how a specific segment of the market is performing. Let's look at some examples. In Singapore, we have the Straits Times Index, which contains Singapore's largest companies such as DBS, OCBC, UOB, and many more. And in the US, we have the famous S&P 500, which consists of Nvidia, Apple, Microsoft, and many more. Most indexes are market capitalization weighted, which means that larger companies make up a greater percentage of the index. So, an index is like a scoreboard of the market. It tells you how a group of companies is performing as a whole. However, you can't actually purchase an index like a stock, and that's where ETFs come in. ETF stands for Exchange Traded Fund. Its main purpose is to copy the index as closely as possible. If the index goes up, the ETF usually goes up similarly. And if the index drops, the ETF drops too. It is designed to track the index, not to beat it. As such, ETFs automatically contain many companies. So buying one ETF is as good as owning hundreds or even thousands of stocks at once. ETFs are great for a few reasons. Firstly, they offer diversification. Investing in one ETF is the same as investing in many different companies. This reduces the risk of betting on a single stock. Secondly, little to no effort is required to maintain your ETF investment, as you don't need to constantly analyze businesses. You just have to buy regularly and hold for the long term. And thirdly, they are emotionally easier. You don't have to stress over the price movement of every single company. And that is why ETFs are perfect for beginners. But the issue is, there are countless of ETFs out there in the market. So which one should we pick? Firstly, we have to decide on the market that we want to invest in. For Singaporeans, the most common ones are the Singapore market, the US market, and the global markets. The US and global markets are known to prioritize capital growth, while the Singapore market tends to prioritize dividends for recurring income. And for that reason, I personally believe that young investors such as myself should be prioritizing the growth-focused US and global markets, as we have a long investing runway ahead of us. Growth also tends to outperform dividends in the long run. For myself, I invest into the S&P 500 every month when I get my paycheck. This is one of the simplest and yet most popular strategies among retail investors. Another popular strategy would be to invest in an all-world ETF. There are many ETFs that track the S&P 500. Some examples include SPY, VOO, and CSPX. They are the exact same product, all built to track the S&P 500, just that they are built by different companies. So, what's the difference between each of them? Well, mainly the taxes and fees associated with each fund. We want to pick the one that has the lowest fees and taxes so that we can maximize our gain. Each ETF has an expense ratio, which is the small fee you pay to invest in the ETF. For example, VOO has an expense ratio of 0.03%. This means that for every $10,000 you have invested in VOO, you pay $3 per year in fees. So yeah, it really can't get much cheaper than that. Next, taxes. For Singaporeans, we actually don't have to pay any taxes on the capital gains that you earn from investing in stocks. However, if you invest in a US stock that pays a dividend, there is actually a 30% tax on the dividend that is paid out. The S&P 500 has a dividend yield of 1.2%, so a 30% tax on that means that you are losing 0.36% of gains every single year. Not extremely significant, but it can add up over the years. Therefore, The strategy is to invest in the S&P 500 via an Irish-Domiciled ETF, such as CSPX. This reduces your dividend tax to 15%, meaning that you save 0.18% of gains every year as compared to VOO. And that will save you $180 a year if you have $100,000 in CSPX, which I am certain all of you will achieve after a consistent 5 to 10 years of investing. So finally, the big question: which ETF should I buy? Many Singaporeans, such as myself, choose between CSPX or VWRA, which is the Ireland Domiciled ETF that tracks a global index. Or you could buy a mix of both, no harm in that as well. If you watched my last video on the IBKR tutorial, you would know that for Ireland Domiciled ETFs like CSPX and VWRA, which are listed on the London Stock Exchange, the minimum fees to purchase these will be higher as compared to US stocks. So, the following is my preferred strategy. If you're investing less than $300 a month, I recommend VOO for an S&P 500 investment or VT for a global market investment. Otherwise, if you're investing larger amounts at once, just go for CSPX or VWRA respectively. CSPX and VWRA are also dividend accumulating funds, which means they automatically reinvest your dividends, while VOO and VT are dividend distributing funds, which means they pay out your dividend in cash to you every quarter. To sum up, ETF investing is a simple, low-cost and low-effort way to get broad market diversification. And historically, broad market indexes like the S&P 500 have delivered strong long-term returns for investors who stay invested, showing that it is one of the best ways for regular people like us to invest. Thank you for watching. I hope that this video gives you a greater understanding of ETFs and motivates you to start investing. Like and subscribe if you want to see more of such videos.